All right. A lot of questions on this. I went into a couple of groups I'm part of on Facebook and said, what are some of the issues we deal with in the state of California? Biggest one is affordability. So really want to kind of unpack this real math behind buying, renting, waiting, building wealth in today's housing market in the state of California. So question that everyone's asking is, can normal people still afford to buy a home in California? Home prices are high, mortgage rates are higher than a few years ago. Insurance costs have increased, rent is expensive. Wages haven't kept pace with housing costs, so saving for a down payment can feel impossible. So, what are buyers supposed to do? So, we're going to go over the big picture, timing the market, money mechanics, and getting creative. Start with the truth. California housing is expensive. There's no magic mortgage program that changes that. Affordability is a real problem, but unaffordable for the average household doesn't mean unaffordable for every household. Question isn't, is California affordable? The question is, what can I afford? Where can I afford it? What strategy gives me the best opportunity? So, how did we get here? Affordability problem. It's really eight things, but we broke down in four bullet points. So inefficient housing construction, high land costs, restrictive zoning, strong unemployment centers, population concentration, desirable markets, expensive construction, lengthy permitting, limited inventory. So combine limited supply with strong demand, housing becomes expensive. So home prices versus household income. Look at this graph here. It shot up like crazy, didn't it? So affordability is not just a mortgage rate problem. So affordability is a monthly payment problem. Most buyers shop by purchase price, but you live with the payment. Principal interest, property taxes, insurance, mortgage insurance, HOA, if you have one, special assessments, flood insurance. So purchase price is only the beginning. There's six numbers that can control affordability. Household income, monthly debts, available cash, credit profile, interest rate, taxes, insurance, HOA costs, right? So change one number and your buying power could change dramatically. Why interest rates matter so much. So rates change buying power. Downside, higher rates can increase monthly payments. Higher payments reduce the loan amount buyer may qualify for. Buyer who could afford at one price at 4% may qualify for substantially less at 7%. So the other side's less competition from other buyers, more seller concessions available, room to negotiate, more time to inspect, fewer bidding wars. It's only one part of the transaction. Let's remember that. Okay. 1% change. Small rate, big payment difference. Right? Look at this. $460 a month from going from 7 to 6%. This is why financing strategy matters. Right? This is principal and interest, so we're not including taxes, insurance, or any of those items. But it does give a good comparison, right? So, reason why I mentioned that on the last slide, just so you know, it goes into this slide. What rates come down? Nobody knows, but if you can buy, knowing that they do dip and they can go up, they do dip, they can come back. It gives you an opportunity to at least buy what's affordable, knowing that there may be an opportunity to refinance. So, mortgage rates are influenced by inflation, employment, economic growth, Fed policy expectations, treasury yields, mortgage-backed securities, global events, a lot of things. And I do a write up on this every week on what's going on with the market. They can change throughout the day as well. But keep in mind, the Federal Reserve does not directly set mortgage rates. Right, I read an entire book on the Federal Reserve, in case you're wondering. You can find it on Amazon called Fed Made Simple. And it kind of unpacks our monetary system in this country. But waiting for the perfect time could create another risk. Home prices could change while you're waiting. All right. So three things buyers are waiting for. Buy when rates fall. I'll buy when prices fall. I'll buy when I save 20%. The problem, buyers are often waiting for all three to happen simultaneously. Historically, that is rare. The better question is, what conditions would make buying financially reasonable for me? Let's look at the cost of waiting. Waiting isn't free. Suppose you wait 3 years. You could continue paying rent. Home prices may increase. Your income may increase, but rates may rise or fall. You may save more money. Circumstances in your life may change, but waiting can be smart, but waiting could also be expensive. You have to run the numbers, right? Okay. So this is saying buy or wait. Potential appreciation, principal reduction, housing stability. Of course, as we mentioned, you're alluded to, future refinance opportunity. Wait 3 years, continue to pay rent, continue saving. Maybe higher income, unknown home price, unknown mortgage rate. There's no universal winner. The answer depends on the assumptions. What if home prices fall? Real estate doesn't appreciate. You need to sell quickly, have unstable income, Well, emergency savings or uncertain where you live, stretching your budget, it may not work, right? So those are risks, 100%. So buying may not be the right decision. Homeownership generally works best with a longer time horizon. But if properties keep rising, right? Let's look at this. 3% appreciation. Let's cut in half. 6 to 7% is what we see in California. Let's just cut in half. $700,000 home, 3% appreciation, which is national average, go from 7 to 765. Same home could cost $65,000 more, right? Your required down payment could increase, property taxes would increase, mortgage rates unknown. Waiting is a financial decision. That's the point here, right? So renting is not throwing money away. Keep that in mind. Renting can't be the right choice because you have flexibility, lower transaction costs, no repair expenses, no property value risk, ability to relocate easily, time to build savings, improve credit. So buying is not automatically better than renting. It's a misconception, right? Buying, but renting has a cost, right? So rent payments do not build equity. Rent can increase 8 to 10% year over year is the average in California. You can have a payment that's $3,000 a month this year and $3,300 a month next year, depending on where you're renting. Keep that in mind, right? So rent can increase. You have less control over your housing. You may not benefit from property appreciation. There's tax benefits, right? So after 5, 10, or 20 years, the difference in household wealth could become substantial. That's why time horizon matters. Compare more than the monthly payment. Renting, monthly rent increases, flexibilities, no maintenance responsibility, no equity accumulation, buying, mortgage payment, tax insurance, maintenance, transaction costs, principal reduction, potential appreciation, tax considerations, not for your CPA. But no, mortgage interest, property taxes, right? Go to irs.gov or use an AI ChatGPT to run analysis on it, right? And compare that financial picture. 20% down myth. You may not need 20% down. Conventional as low as 3% down. FHA 3.5. You qualify for VA, 100% financing, same with USDA. And then there's down payment assistance. So the bigger question is, can I put 20% down? It's how much should you put down? What works financially for you? So how much cash you actually need? Cash at close has multiple parts. Down payment, closing costs, prepaid property taxes, insurance, initial escrow funding, inspections, appraisal reserves, potential moving expenses. So not every dollar you have, don't use every dollar you have to buy the house. Liquidity matters. I've written a book called Fearless Money. Check it out on Amazon. A little plug there, but it talks about budgeting. And I love to coach my clients through budgeting. You want to get a call with me at the end of the slide presentation, scan the QR code. We'll do it. You have to apply. Just help you with budgeting. It's totally fine. A larger down payment may lower the payment, reduce mortgage insurance, improve pricing, strengthen the offer, reduce debt to income ratios. Keeping cash may emergency reserves, investment opportunities, repair funds, business liquidity, future flexibility. The biggest down payment is not always the best financial strategy. Seller credit is one of the most powerful tools right now as I'm recording this, July 2026. Seller credits, we're seeing a lot of them. Days on market increasing. The seller has to sell the property, right? Less buyers. Get help with closing costs, prepaid expenses, buying your rate down, other eligible costs. So instead of negotiating $20,000 off the purchase price, you may benefit with a credit towards closing costs. So negotiate the transaction, not just the price, right? So let's talk about temporary buy downs. A 3-2-1 buy down. Say the rate's 7%. On the 3-2-1, starts at 4. Next year it goes to 5. Year after that goes to 6. Then it goes back to year 7. The 2-1 buy down starts at 5, year 1. Year 2 goes to 6. Year 3 goes to 7. 1-0 buy down starts at 6, goes to 7. So the seller can contribute to this. Start to pay. Keep in mind that the note doesn't change, but it would temporarily reduce that monthly payment for the buyer. Benefits, lower housing expense and housing payment, time for income to increase, cash flow flexibility, and of course, a refinance opportunity when rates improve. It's not if, when. I think they will eventually improve. We just don't have a crystal ball. I'm not the Lord. I don't know when, but I think it will. So the buyer must qualify according to applicable program guidelines. Down payment assistance. These are available in California. There's over 70 of them that I'm aware of. CalHFA, my home, the Dream Fall program is part of CalHFA. The Golden State Finance Authority. There's city and local programs, county programs, employer assistance Kaiser has a great one for their physicians, community programs. So not every assistance program is free money. So understand the repayment terms, right? We go over that with our clients. So the affordability ladder, rent, get a condo, townhome, starter home, move up home, investment property, long-term wealth. First property can be the beginning, not the destination. I did that. I have a few rental properties now. I'm going to say on this call how many, but I did my first property that I bought was a townhome in 2009. So I could afford, paid off as a rental, does well. Another property after that, paid off, rental, does well. And they did it again and again. It could happen. It's easier than you think. Condos and townhomes. Let's talk about the overlooked entry point. Benefits, lower purchase price, or maintenance responsibility, desirable locations. First step into homeownership. Challenges, HOA assessments, insurance. Condos can be difficult in this market. I have a couple presentations on that, but it's important to review the project before removing contingencies in these cases. But knowing this is a great way to start. I did. Another one is house hacking. I wish I did this one. Buy a 2, 3, or 4 unit property and rent out the adjacent units. Live in one. This helps. Why? Well, then you move to your next property. You have a rental property renting at 2, 3, or 4 doors, right? This is good stuff. Conventional allows you to do 5% down on these, FHA 3.5, but there's an additional part to FHA that's required, where it's a stress test, if you will, to make sure that the rent would carry the mortgage. So conventional is probably the better play there, but you can do an FHA mortgage on that as well. One loan, multiple units. Great program. ADUs, California's backyard opportunity. See more of these. May provide rental income, multi-generational housing, housing for aging parents, space for adult children, property flexibility, potential property value, right? It's huge. ADUs definitely help value. Evaluate them before you build. Permits, construction costs, financing, appraisal impact, what the rental income of that area looks like, and local requirements, all important stuff. So buy smaller first. Most buyers make one mistake. They try to buy their second home first. Don't do that. Consider a smaller place, older property, different neighborhood, condo or townhome, cosmetic fixer, maybe a longer commute. Your first purchase could create options for your next purchase. I did. That's our story. That's my wife. Worked out. Geographic flexibility, move the map. California affordability could change dramatically within 20, 30, or 50 miles. Again, I'm from San Francisco. I was living in Marin. We ended up getting our first place, or I got my first place in Petaluma, California, in Sonoma County. It worked. So here are questions. Can I work remotely? Can I tolerate a longer commute? Are there emerging neighborhoods nearby? Could I buy in a neighboring county? Are schools and lifestyle more important than a zip code? Sometimes the solution isn't changing the loan, it's changing the state search area. So alternative financing, in case if you're self-employed, there are loans that work. Bank statement loans, profit and loss loans, asset depletion. If you're buying investment property, there's DSCR loans where it actually uses the income of the property to qualify. There's a lot of programs here. The best qualified borrower on paper isn't always the borrower with the highest tax return income. Remember that. Existing homeowners have options too. You may face large equity positions, low current mortgage rates, a home that may no longer fit your need, or if you're giving up a low idea, but there's strategies, bridge loans, home equity lines of credit, buy before you sell programs, temporary buy downs, seller credits, keep the departing residence as rental. A low mortgage rate is an asset, but shouldn't become a prison. 5 biggest affordability mistakes. Shopping by purchase price instead of budget. Number 2, waiting for the perfect market. Number 3, assuming 20% down is required. Number 4, using every dollar for the down payment. 5, talking to a lender after finding the house. Affordability strategy should begin before the home search. Who should wait? If your employment's unstable, if you don't have reserves, if you have high interest debt to address first, you don't know what you actually want, and you may relocate soon. If the budget's already stretched and your career profile's likely to improve significantly. So sometimes the best mortgage advice, candidly, is just not yet, and that's okay, right? So here's a playbook for California affordability. Build the budget first. If you want a budget booklet, a book on budgeting, shoot me a message, drop a comment below. Happy to get that to you. Get fully underwritten before shopping. compare multiple loan structures, consider less than 20% down, negotiate seller credit strategically, compare rate buydowns with price reductions, explore assistance programs, consider condos, townhomes, ADUs, expand the geographic research, and build a 3 to 5 year strategy. If you want, when we get on a call, we'll discuss income, available cash, what you're comfortable with. May not be the same thing as what you're approved for, right? Where you want to buy. We'll evaluate these things, price range, loan programs, down payment options, seller credit strategies, assistance programs. We'll build out a dream scenario for you. 4 numbers, 1 strategy. If you want to do that, there's a QR code. Let's schedule a time. Let's talk. Let's hang out. There's my contact information. Feel free to call, text, or email. And really appreciate you taking the time to join us here today.